Hey everybody, it's Doug Shoemaker with the Shoemaker Loan Team at Homestead Financial Mortgage, and welcome to 1 Minute Monday. Every week, I'm going to break down the top mortgage and housing headlines. First, I'm going to give my friends who just want to know what time it is the 60 to maybe 90-second version, and then I'm going to go to a full deep dive for the ones who want to know how the clock actually gets built. And brand new this week, if you stick around to the very end, you're going to get our new Building the Clock segment, where I'm going to teach you one of the tools that we use every day so that you can understand what actually moves rates. So if you get value out of this, do me a quick favor, hit that like button and hit subscribe so that you never miss a Monday. It really helps me keep bringing this to you every week. And for those of you that already have or you're about to, I sure do appreciate you. All right, let's go ahead and get into it. For my friends that just want to know what time it is, here's the quick rundown. Home prices are still up compared to last year, but the pace of appreciation, it actually slowed a bit heading into fall. Pending home sales, they jumped 1.9% in October. That's the strongest level all year. Continuing jobless claims, they're near 4-year highs, and people that are on unemployment, they seem to be taking a lot longer to find new jobs. Now, September retail sales softened a little bit. Control group actually went negative. Wholesale inflation, it ticked up almost entirely because gas spiked 12%. Now, Black Friday online spending hit a record $12 billion, but a lot of that was on credit. The Fed's Beige Book, it showed a flat to weaker economic activity, and it actually showed softening labor demand as well. And markets this morning, well, Japan comments pushed global yields higher, and bonds are down 19 basis points to start the week. Now, this is also a really big data week as well, so stick around to the end of the video and I'll go over all the stuff coming out this week. So for my friends that would like to know how to build the clock or how it actually works, let's dive into the full update. Home prices are still up, as we said, year over year, but that pace did slow. Case-Shiller showed a tiny 0.3% decline before the seasonal adjustments, but they were up 0.2% after those adjustments. Nationally, we're still about 1.3% up year over year, and that's just a hair slower than what we saw in August. So FHFA, which is conventional loans only, that was literally flat month over month, but it's up 1.7% year over year. So the bottom line is that prices are still rising, just not nearly as fast as they were. If rates keep drifting lower, demand is going to come back and prices are definitely going to heat up again. Now, for pending home sales, they rose in October. They were up 1.9% month over month, and this is the best reading of the entire year, only down about 0.4% from last October. Now, pending sales lead closings by about 30 to 60 days. So December and January, they should look a lot busier than the last couple months. Lower rates plus more inventory, that equals buyers stepping back in. Now, continuing unemployment claims, they highlight slower hiring. Initial claims dropped to about 216,000. That's nice and low, but continuing claims rose to 1.96 million, and that's one of the highest levels in 4 years. The translation here is that layoffs are still moderate, but when people do lose their job, it's taking them a lot longer to land that next one. Now, this is a classic cooling labor market signal. Now, for September retail sales, shoppers, they look to be pulling back a tad. Overall, it was up only about 0.2%, and the control group actually showed a negative 0.1%, and that's the first decline that we've seen in 5 months. So consumers, they might finally be tapping the brakes a little bit. We'll know a little bit more whenever October, November numbers finally drop. So for wholesale inflation, energy prices did the heavy lifting. PPI was up 0.3% month over month, and that was almost all gasoline. Core was pretty tame. So nothing here that's going to freak the Fed out or spike the upcoming PCE reading. Now, what to look for this week? It's a busy one. Tomorrow we've got mortgage applications, ADP employment, and ISM services. Thursday we've got jobless claims, challenger job cuts, and Friday we've got September PCE. And that's literally the Fed's favorite inflation gauge. Now, this data cluster, it's going to help shape the December Fed meeting in a big way. Well, friends, we will have a new sheriff coming to the Fed. President Trump, he's already made his decision on the next Fed chair. The announcement could come literally any day. Now, names in the mix are Christopher Waller, Kevin Warsh, Kevin Hazlitt. One way or another, markets are going to move the second that name drops. The Beige Book showed weak economy signals, little changed economic activity, declining consumer spending, labor weakening in half the districts, and companies are cutting hours and freezing hires instead of doing big layoffs. This is not quite the picture of a rip-roaring economy. Well, what about Black Friday online this year? It was up a record 12 billion, and that's 9% increase from last year. But a big chunk of that was on credit cards. Now remember, credit actually pulls future spending forward, but then debt service slows it down. What I mean by that, having to make the payments on all that debt later, that reduces the actual cash you've got to spend on things. So that's why it slows activity down later. Now, for the technical picture, Friday we closed in a new range. Support was 101.17. Resistance was 101.44. The 10-year was testing that 4% floor. Now, this morning, Japan's governor really spooked the market big time. Bonds opened down about 19 basis points. The 10-year yield was up 7 basis points. And now it's broken through its 25 and 50-day moving averages. If it holds above, the next step is roughly 4.126. Now, mortgage bonds are lower, but still sitting right on a dual floor. The 25-day and the 50-day moving averages are really acting as a floor of support, keeping bonds from crashing through that. It's also kissing the 61.8% Fibonacci retracement of the recent rally. Now, Japan moves are usually short-lived, so we're going to watch this really, really closely throughout the afternoon. And if anything changes, we'll get an alert out on the Shoemaker Loan Team Facebook page. Now, for our rate lock guidance this week, as I said, inside 15 days, we're carefully floating. We really want to see bonds close above that dual support line and ideally above that 101.17 Fibonacci level. Now, outside of 15 days, I feel like it's safe to float for now, but just make sure you stay on high alert. Make sure you're checking out our updates as often as you can. All right, clock builders, for our newest segment on clock building, let's talk Fibonacci. And I'm going to give it to you the way that I would actually explain it to a new loan officer on our team. Now, there's this mathematical sequence that shows up literally everywhere in nature. Now, you've seen it as the spiral on a seashell, the way that petals are arranged on a flower, the way that pine cones look, even hurricanes spin with it. So it's called the Fibonacci sequence. And when you turn those numbers into ratios, you get these magic percentages: 23.6, 38.2, 50%, 61.8, and 78.6. Now, nobody's 100% sure why, but markets, which are just millions of humans making decisions, they tend to breathe in and out using those exact same ratios. So when bonds or stocks or really anything make a big move up and then they pull back, they almost always pause or reverse at one of those specific Fibonacci levels. So here's an example. Bonds just rallied from roughly 101.17 to about 101.8. That's a 63 tick move. This morning, after the Bank of Japan noise, guess where they opened? That's right, smack dab on the 61.8 retracement of that entire rally. Now, the golden ratio, the level that catches reversals like crazy, that's why I'm not panicking on this right now. We're sitting right at that same mathematical level that seashells and sunflowers and puppy dogs, rainbows, and unicorns, and the bond market actually all respect for some weird reason. If you add in that 25 and 50-day moving average right underneath, now you've got a textbook spot where the big money usually steps in and defends. So next time you hear me say, hey, we're testing the 61.8 fib, now you know I'm not just throwing around fancy Italian words to sound smart. I'm actually talking about the same math that built the Nautilus shell in your kid's science project. And it's telling us this is a high probability spot for bonds to bounce. So there you go. 3 minutes, done. You just got the real story behind one of the most powerful tools in trading. Now go impress somebody at the dinner table tonight. Well, it is time for the family hack of the week. And tomorrow is actually National Cookie Day. So grab the kids, turn off the phone and the tablets, and make a batch of classic sugar cookies together. Now, there is a super simple recipe in the description. It makes 4 dozen, makes your house smell amazing, and boy, does it make some really cool memories. Well, folks, that is our post-Turkey Day update. If you're buying, refinancing, or you just want some straight no BS guidance on rates and strategy, reach out anytime. Already started somewhere else and not getting the education or service you feel like you deserve? Shoot me your current loan estimate. I'll review it personally for you for free. And if you're getting the deal of the century, I will let you know. If not, I will also let you know. And honest answers here, they're always free. So don't keep us a secret all. Make sure you share this with somebody who needs it if it's not you. Happy holidays, everybody. See you next Monday. Go crush your week.